I'm Debra Brennan Tagg, President of Brennan Financial Services. Welcome to the Market Report for the second quarter of 2018, and thank you very much for joining us. Last quarter in this market report, I talked a little bit about the fact that parts of the market had actually stalled. And while that did continue through the second quarter, there's some really bright spots. There are three trends that we're going to talk about in this quarter. The first one, we all know it's coming: Trump, trade, and tariffs. Theme number two is going to be about inflation. Is it here or is it not here? And our evergreen theme, diversification. The purpose of this market report is to really give you some context about what's going on in the market, to look at short-term trends, and to look out a little bit to see what's coming towards us. We are basically your nerds who will do all the analysis on the financial market so you don't have to. Let's dive right in. We'll start with the market summary, which shows why diversified portfolios probably have lower returns this year as compared to last year. The U.S. stock market had a return of 3.89% this quarter, but we'll peel that apart in a few minutes in the report. International stocks were off and emerging stocks were way off, while real estate saw a much-needed recovery and bonds were basically flat. Let's focus on the bond story for a minute, which really tells itself here. It's up a little, it's down a little, it's really doing nothing for performance for us this year. And while bonds are admittedly having a difficult time right now, they're generally held in a portfolio more so to reduce risk than to create huge performance. We've had a lot of questions from our investors about whether they should still hold bonds in their portfolio. And so we have to remember, unless they are very, very aggressive investors and want to have near 100% exposure to the stock market, bonds still do have a place. This chart, in fact, highlights it. If we look under the U.S. bond market at the best quarter with a return of 4.6% and the worst quarter with a return of negative 3%, it's not a very big spread. If we look at the U.S. stock market, by contrast, the very best quarter there is an impressive 16.8%, but the worst quarter, just in 3 months, it lost 22.8%. And so if you have the ability to stay in as an investor and be exposed to that much up and down, well, then stocks may be the right place for you to be. But if you don't want to have quite that much exposure and you want to remain fully invested, again, bonds will return some returns for us, and they also will reduce the risk in the portfolio. Now we'll take a look at some of the headlines that dominated just the second quarter of this year. The one thing I really want to draw your attention to is the IMF forecast global growth of 3.9% this year. The IMF is the International Monetary Fund, and so they're really talking about the entire globe and all the countries together. The U.S. Foundation is equally strong, and we are seeing very strong indications of GDP. There is no concern right now about the foundation of the economy. So some of the things that we'll be talking about in the market report may make you think, I wonder how things are going in the stock market and the economy. The economy is as strong this year, both domestically and around the world, as it was last year. We haven't really seen any fundamental shifts there, but there are some things that we need to be paying attention to. One of them is that the yield on the 10-year U.S. government bond hit 3% this year, and that hasn't happened in a long time. That's one of the problems that the bond market is having. We'll be watching that, and we'll be bringing more information to you about that in further market reports. The other thing I want you to start thinking about is all of the jobs that are out there that have actually been filled. And so our unemployment report is very, very low. And while that's great for the economy currently, at some point when we reach maximum employment, which is where we are right now, and get even beyond that, at some point we're going to have to see that number start to bounce back a little bit. And that may be one of the signs that we are starting to see the economy slow. There's not a recession that is on the near-term horizon, and we'll let you know if that's something that we start to have any sort of concern about. And then we'll start taking a look at one of the themes that we have in the market report, and that is inflation. There's lots of discussion about whether we have inflation or not, and we did see the inflation rate hit a 6-year high in May. That doesn't mean that we have extreme inflation, and so lots of people have started getting very nervous about the markets and what does that mean if inflation comes in, and will the Fed raise interest rates to combat inflation? Right now, even though inflation is higher, it is not something for us to be concerned about. Now we'll take a look at the headlines from the past 12 months. We still see lots and lots of positive data here about the stock market, about the economy, about U.S. companies, so nothing new here for us to be concerned about. One of the issues I do want to highlight is the tariff talk. So it's tariffs, Trump, and trade. There are two things that economists generally agree on, and that is the value of education and the fact that a trade war is not a good idea and does not have positive results. So that is the backdrop for the tariffs that are going on right now. The tariffs have changed considerably since Trump has announced them the first time, and they probably will continue to change. And it's the changing and uncertainty that we have the most concern about. There's not really good data right now about the effects that we can expect from the tariffs that have already been put in place. There's a lot of conjecture, there's a lot of analysis on both sides, and the numbers are not really that compelling because they're not backed up by true data. What we have more concern about is the uncertainty around the tariffs and what that causes for U.S. companies, for international governments. And so the concern would be that if U.S. companies specifically are not sure what the rules of the game are as far as how they're going to produce something, then they don't know how to play. And a great example is Harley-Davidson. They decided that they were going to move their production overseas, and obviously that was a big media nightmare for them. So what we really want to see is more certainty around it, that either the tariffs are in place and done, and we're going to follow through on them, or that it's something that is not going to be as severe as Trump has talked about. So we're watching this closely. Economists are watching this closely. Anyone who runs a U.S. company is watching this closely. And it is one of our greatest concerns right now as far as factors that we cannot predict very well for the stock market and for the economy. This chart always fascinates me because it reinforces my diversification theme so well. In the first quarter of the year, we saw that the two sectors that were positive were emerging markets and 1-month Treasury bills. Those sectors are complete polar opposites on the risk spectrum. Meanwhile, the vast middle ground of assets, including broad U.S. stock and bond indices and developed international indices, and real estate, they all lost ground. That was the first quarter. Now, in the second quarter that we're looking at here, 1-month Treasuries eked out a little bit of a gain, but real estate came roaring back, and then emerging markets did an absolute nosedive. So anyone who says they can time all of these movements is just not telling the truth. All of these different sectors play off different themes at different times, and it's why it's so important that we have the right assets mixed together in a long-term portfolio. Here we're looking at the U.S. stock market return for the second quarter of 2018. We are happy and not at all surprised to see that small cap stocks are leading the pack in performance this quarter. We had a really strong belief in small cap U.S. stocks coming into 2018 and in fact rotated more money into that sector in our portfolios. That was mainly because of the tax reform, and we believed that the tax reform would have a positive effect on small caps. They've had that nice strong momentum since the beginning of the year. They've also had an added benefit that they have not been nearly as affected by all the tariff discussions, since they are far less likely to have substantial multinational operations. So even with discussions about the tariff talk, that has been a headwind against large cap U.S. stocks. And if we drill down here, we see a real divergence in the return numbers. So let's just focus on large cap for a minute. The large cap stocks had a return of 2.85% this quarter, but large cap value by itself had a negative return of 1.69%. And then if we contrast large cap with the 2.85% return with small cap, it had a return of 7.66%. So that's a huge disparity there. If we look market-wide, though, I want you to draw your attention not just to the year-to-date numbers, but the 1 year, the 3 year, the 5 year, the 10-year returns, all double-digit positive returns. And I want us to think about the fact that if we take a little breather this year, especially in the large cap space, after the great returns that we saw in 2017, that is just fine. There was lots of discussion last year about the fact that the market had gone up so much that we might need to see a correction. I would trade a sideways movement for half a year any day for an actual correction in the stock market. While the U.S. stock market performance is mostly positive year to date, international stocks are mostly negative year to date, which is a real contrast to 2017. One of the things that we talked about a lot last year is how we were really happy with the improved fundamentals in many of the economies and lots of central bank policy around the world in 2017. Now we're seeing some more uncertainty in the international markets, which is not surprising given all the tariff discussions around the world. More on that as the story unfolds. The emerging market stocks, which had a really strong and robust performance last year and all the way into the first quarter of this year, really decided to give up some of those gains in the second quarter. So we see all asset classes under emerging markets post negative returns for the second quarter. Investors who are invested in emerging markets just need to remember that while they can provide periods of high returns, there's also very high levels of volatility in emerging markets. Real estate investment trusts, or REITs, had a knock it out of the park kind of a quarter. U.S. real estate had solid long-term performance until 2017, but then they've really suffered in performance over the past year. Interestingly, the nearly 10% return for the second quarter only brings the year-to-date number to 1.82%, which tells us that this quarter was mostly a positive correction for last quarter's bad performance. We do like to include real estate in our portfolios based on what our clients want to achieve and if it's a good fit for their goals. The numbers here are for publicly traded REITs, which are affected by all of the influences of all the public markets, and that includes interest rates, inflation, and Fed decisions. We still have a preference to use private real estate investments, which can reduce the effect of some of those market forces and ease out some of the volatility. I always take a bit of time to review commodities as a reminder of why we seldom include them in our portfolios. The 3, 5, and 10-year performance numbers are still strongly negative. What's interesting is that the 1-year positive return number finally gives us a little glimmer of hope, especially for our clients and friends who work in the oil industry here in our home state of Texas. Crude oil continued its really strong positive performance in the second quarter, and as we saw in the market headlines, has room to run if the supply continues to shrink and the demand remains strong. We talked about fixed income, also known as the bond market, at the top of the report. And you can see from the performance, there's just not a lot here that's truly compelling. These are not the kinds of returns that you're going to be talking about at cocktail parties. Again, what is most important here is that bonds can reduce the risk in a portfolio. We are in a tough time for bonds, but we don't have an intention of bringing them entirely out of the portfolios because they are just such a good risk reduction tool. Also, there are reasons that bonds could turn around and have a sudden, stronger performance. One of those examples is earlier this year, there was some concern about Italian debt. And at that time, lots of institutional investors sold Italian bonds and bought U.S. bonds, which increased the demand, which temporarily increased the prices. We don't want to count bonds down and out just because interest rates are going up. We have to understand there are many, many factors that can influence them, and they have a long-term purpose in portfolios. And now we've arrived at my favorite slide. It's the one about diversification. And we can see here how the returns have been for clients that have stayed invested, which is a key element, over a 10-year time period in various kinds of portfolios. From very, very conservative, meaning 100% treasury bills, all the way up to very aggressive, meaning 100% stocks. Interestingly, in this time period, the year-to-date number on the stocks is negative, but otherwise, all of the portfolios are positive. And for us, we've talked about this a lot with our clients recently. It is not my job to convince a client to be in the stock market or in the bond market. It is my job to make sure that clients are appropriately invested so that they can handle the ups and downs and that they're happy with the amount of up they can get long-term from the portfolio, as opposed to the downs, so that they don't call us at some point and say, hey, this market is too much for me, I need to come out of it at a time when maybe the market has fallen off somewhat. So it's more important to us that our clients have an understanding of what their portfolio can do over the long term and that they can stay committed to that portfolio so that we can help them achieve their goals. Thank you for joining us today. We are a holistic practice focused on both financial planning and investment management. We manage diversified portfolios that are all fine-tuned to the amount of risk that our clients can handle so that they can stay in through different market cycles, both the ups and the downs. If you have any questions for us, please feel free to email us at teamdbt@brennanfinancialservices.com or check out our website at debrabrennantagg.com. And you'll learn more information there about how we help our clients to use their money to have the lives they want.